Right at the end of 2020, I sold an MIT spin-out I had previously co-founded. In 2021, I took a portion of those funds and made my first investment in an AngelList rolling fund. Now, 21 and 22 were hot for startups with lots of interest and money flowing into rolling funds. By the end of 22 and through 23, the market started to drop, as did interest in rolling funds, and this gave me a real sense of the dynamics and pitfalls of the rolling fund structure. I'm going to explain the basics of AngelList rolling funds and talk to you about some of the strategic perspectives I've picked up over the last few years. I'm going to split the presentation in two. First off, I'll explain to you different fund structures. Understanding special purpose vehicles and venture capital funds will help a lot with explaining the differences, benefits and trade-offs with the rolling funds. Then I'll talk a bit more strategically on some of the lessons I've learned with rolling funds, notably how quality of the investments depends on the manager's deal access, how the effective fees, as opposed to just the headline fees, depend on the subscription period, and last of all, I'll talk about some adverse selection that can apply due to market cycles and also at the deal selection level in these rolling funds. To start off, as I said, I'll cover the structure of SPVs and VC funds, starting with SPVs, which are special purpose vehicles. Now, typically these are used for a one-off specific purpose, and they're often to combine smaller investors into a larger investment that can go onto a cap table. There are a few specific cases I can give. For example, if a founder is raising money from many investors, they might have some smaller investors, perhaps friends or advisors who want to invest, but there might be a lot of these, maybe 20, and rounding up those signatures down the road can become a lot. So rather than have an individual investment from each smaller investor, these might be grouped into a special purpose vehicle so that there is just one investment by that vehicle that's recorded on the cap table, which is a list of investors in the founder startup. Another use for special purpose vehicles has to do with pro rata rights. When an investor makes an investment in a startup, they often have the right to maintain their percentage ownership in future rounds if they continue to invest. For example, if they buy a stake of 5%, they may be allowed to invest at each subsequent stage and maintain that 5% ownership. However, if the company is very successful, it may require quite a lot more money in order to maintain that ownership. But there's still value there to having the option to invest, and an investor who cannot maintain their pro rata might opt to give it to somebody else. One option is to create a special purpose vehicle, take in funds from those who do have money, perhaps take a fee from that, both now and also as a share of profits, and then invest that because you have the right according to an earlier investment. The last scenario is the approach that is taken by the syndicate. The syndicate, which is an organization run by Jason Calacanis, allows investors to decide on a deal-by-deal basis to invest in startup investments that Jason and his team propose. In each case, there will be a special purpose vehicle that is set up, and investors' money will go into that vehicle, and that vehicle will become an investor in the end startup. This allows a granular way where investors can choose on a case-by-case basis which startup and which SPV they want to invest in along the way. Typically, a special purpose vehicle will have a manager who selects how and where the funds are invested, but it's usually in one company. And there are the limited partners who are the investors that put money into that special purpose vehicle. Structures vary, but one representative structure would be to have a 5% fee that's partially used to cover the legal costs of setting up this entity. Furthermore, often 20% of the profits above and beyond the initial investment are paid out to the manager, and this is called the carried interest. For example, you might have a special purpose vehicle with 10 limited partners or investors putting in $10,000 each. That means the SPV size is $100,000. Now there might be an upfront fee of 5%, so that's $5,000 in fees, and that's split across investors according to their investment size typically. That means there's $95,000 that would be invested in the startup. Looking at that graphically, you have 10 investors putting in $10,000 for a fund of $100,000. $5,000 leaves in fees, and $95,000 would go into that startup. Down the line, perhaps that startup would be liquidated, maybe it goes public and the shares are sold, or maybe it's acquired. Let's consider a case where the proceeds are $200,000. Now, investors will get paid back their original $100,000, plus they'll get 80% of the profits. The profits in this case are 200,000 minus 100,000. So 100,000 of profits times 80% is $80,000 in profits. The managers take 20%, and so in this case, managers would earn 20,000 of profits on this SPV. Next, we'll move to an angel or VC fund. This is like a special purpose vehicle, except it is typically diversified across multiple investments, perhaps across 10 or more startup investments. Investors into the fund delegate the investment selection decisions to the fund managers, and the fund provides investors with diversification because it invests in more than one company. The fund structure is somewhat similar. There are typically limited partners. They are the investors that put money into the fund, and general partners who manage the fund. They decide which startups to put the money into. The fees on VC funds, they also vary, but often might be 2% per year over a 10-year fund period, and 20% of the profits, if there is a profit, also go to the general partners. For example, you might have 10 limited partners that each put in $10 million each for a fund size of $100 million. If there's a 2% fee applied each of the 10 years, that would be a total of $20 million in fees. That leaves $80 million for investment in the startups. Perhaps $8 million might be invested in each of 10 startups over a period of 1 to 4 years. Just to show that graphically, you would have 10 investors putting in $10 million each to create a VC fund of $100 million. 20% of that will leave in fees. That leaves $80 million, which might be invested in 10 chunks into 10 different startups, receiving $8 million each, for a total, as I said, of $80 million invested. Now, if we play that forward, over the remaining 4 to 10 years of the fund, perhaps those investments are liquidated. Either they go out of business, they're acquired, or they go public. Let's consider a scenario where there are $200 million in proceeds. Investors now get back their $100 million original investment, and they get 80% of the profits. The profits being 200 minus 100, so 80% of 100 million is 80 million. The managers, on their part, earn 20% of the profits, which would be 20 million in this case. Let's take a look at what the returns are for the investors if you ignore fees and then if you consider fees. We'll stick with the same example, where there's $80 million that eventually goes into the startups as investment. So if you ignore fees, on a base of 80 million of investment, this fund has delivered a return of 200 million. Over a 10-year period, if you assume the 80 million was invested at the start and the 200 million returned at the end, that's an annual return in IRR terms of about 9.6%. In reality, you have to consider fees. So the investor's upfront cost is not the 80 million, it's the full 100 million, including the 20 million of fees. And the return is not the full 200 million because of the general partner share, it's rather 180 million. So the return is 180 million. If you compute the annual return for 100 million investment upfront and 180 million returned in 10 years, that gives an IRR of about 6%. So you can see there's a very material difference in the returns that the investors receive owing to the impact of fees. This is something to keep in mind with special purpose vehicles, with venture investments, and later, as we'll see, with rolling funds. There are two more things I want to explain. The first is the fund cycle, and the second is the idea of capital calls. Let's start with fund cycles. During years 1 to 4 of a 10-year fund, general partners will typically be making investments of that money. Over the course of the full 10 years, and perhaps a bit longer, they'll also be sitting on boards of those companies and helping portfolio companies to advance, raise new investment, and perhaps to be acquired or to go public. But importantly, once the general partners get to roughly years 3 or 4, or maybe years 3 to 5, they'll start to think about raising a next fund. And so significant time needs to be spent finding new investors for Fund B. And so there's this cycle that will repeat itself roughly every 3 to 5 years, where investors are focusing time, raising money, then deploying the money, and then in tandem to helping their portfolio companies finding a new round of investment so they can start the very next fund. And this is a very important part of running a venture capital fund. It's a very big time sink, and it's also one of the frictions if you want to get into the business of being a manager. We'll see how rolling funds address that in some ways. The other concept to appreciate is that of capital calls. If you have a venture fund of 100 million, the investors don't immediately give you the 10 checks for 10 million each. Rather, the general partners will ask their investors to wire them money as they need it. So as the general partners identify startups in which to invest, they will make a call to their limited partners, the original investors, and tell them to send over the funds that are needed to make the investment. In this way, the investors' funds aren't sitting idle and they're only called upon when needed. Likewise, if a company is acquired or goes public, the managing partners typically might decide to return those funds to investors before the end of the 10-year period. There are some complexities here around how this affects the calculation of the fund's performance, notably the IRR, because it depends on the timing of when the funds are drawn and when they are paid back. But the message I want to get across here is that the funds are not all paid up front, and this works because there are typically a small number of large investors that can be called upon and relied upon to send the money when it is required. If you think about increasing the number of investors in your fund, this becomes more and more difficult because you would have to contact so many people to send the money when you need it. And that brings us to the idea of an AngelList rolling fund, which allows for smooth investing by making it a subscription. For example, a manager will launch a fund and then investors will agree to subscribe and they will pay in a fixed amount every quarter for a certain number of quarters. For example, they might invest 25,000 per quarter over a period of 4 quarters. So every quarter, the manager knows how much money they have to invest. And if there's anything uninvested at the end, it simply rolls over into the next quarter. Now, the fund structure is quite similar for each quarter as to a VC fund. There are limited partners, but there can be many more. In a VC fund, there might only be a handful of limited partners, or maybe 10. But in an AngelList rolling fund, you could potentially have hundreds. Rolling funds also have a general partner, or potentially, but less commonly, multiple general partners, and these decide into which startups they're going to make the investments. The fees also tend to mirror VC fund structures, 2% fees per year over a period of 10 years. This can vary depending on the rolling fund, sometimes be a bit higher or sometimes a bit lower, and uniquely, these funds and fees are often taken right at the start when it comes to an AngelList rolling fund. There's also a 20% profit share that's earned by the general partner of the rolling fund. Again, this can vary and sometimes it's even higher. So if you look at the first quarter of a rolling fund that has 10 subscribers subscribed at 25,000 per quarter, that means there would be 250,000 available in the rolling fund for the manager to deploy that quarter. Now 50,000, which is 20%, will go to fees, leaving 200,000 available to invest. But if the manager only invests in 8 startups at 20k per investment, that means 160k has been invested and 40k will be rolled over. So starting the next quarter, let's say there are 10 new subscribers, giving a total of 20 subscribers at 25k each. That means along with the 40,000 that rolls over, there's now 500,000 of new funds available this quarter. 100,000, 20% of that, will go to fees. This leaves 440,000 to invest. So if the manager can invest in 22 startups, just for example, at 20,000 each, that means the full 440 available would be invested and there's nothing that rolls over to the third quarter. Let's start now the third quarter considering the same number of subscribers as the second. That's 20 subscribers at 25,000 each. So the fund has 500,000 to invest and there's nothing that is rolled over from the second quarter. 100,000 of that, which is 20%, goes to fees. And now consider that the fund manager makes investments in 10 startups at 20,000 each. At 20,000 each, that's a total of 200,000 invested, leaving 200,000 to roll over to the next quarter. And so this process goes on and can adjust dynamically to take on new subscribers or to allow subscribers to leave. Now, this is good for managers because it smooths out that problem of capital raising that VC funds face every 3 to 5 years. The money is also directly debited, so there isn't a question of capital calls and reaching out to investors to get the money every time an investment is made. It's entirely predictable how much money is available to invest each quarter. This gives VC fund benefits to smaller investors because it allows them to delegate the selection of investments to somebody with more skills, and it gives them some diversification. Next, I'm going to consider some of the more strategic points I've learned along the way with respect to these rolling funds, notably around the importance of deal access, the importance of understanding effective fees versus nameplate fees, and lastly, some of the adverse selection risks you face as an investor in a rolling fund. Access to great deals is important in any type of investment, but perhaps particularly so with rolling funds. This is because rolling fund managers will rarely negotiate the price at which they invest in a startup. Say, for example, 10 million is being invested in a startup. The price of that investment will typically be negotiated by a larger investor, which is often a VC. Out of that 10 million, maybe the VC will invest, say, 9 million, leaving 1 million that can be invested by other advisors or smaller investors. And the question of which investors to allow to invest that 1 million is determined based on the skills, the network they offer, and the signaling it offers to the startup if that person is allowed to invest. And so rolling fund managers are competing based on what they can offer startups and also based on the startups that will come to them seeking investment for signaling. Now, skill, status, network, these phenomena are all fat-tailed, which means that those who have the strongest network are far, far stronger as networks than the average rolling fund manager's network. So if you invest in rolling funds, it is possible to find rolling fund managers that will have vastly superior networks to what you yourself or I myself might be able to have. And since it's network that drives getting into these top deals, that is also going to drive performance. Of course, with any market, there is a supply and demand dynamic. So as you have rolling fund managers that have very strong networks and perform well, there will be a higher demand to invest in their rolling funds. In some sense, you will see that higher performing managers might have higher fees. For example, you can see a list of rolling fund managers here. Notice, by the way, how many of these are founder-led, because many of the top successful founders are those who have the strongest networks and signaling for other investors if they invest in a given startup. Now, if you look at the fees, I'll just increase my screen size a little bit. You'll notice that they're all roughly around that 20% for the carry. And if I zoom out here, because it won't show it otherwise, you'll notice that the management fees are roughly around 1 to 2.5%. And to some extent, if there's more demand for a fund, they can afford to increase the fees. But in practice, it just seems too unreasonable if you charge a carry of over 30%. And so the supply-demand dynamic plays out in a slightly different way. In fact, what happens if a fund manager is very successful is that lots and lots of money will come into the fund. But as they have more money to deploy each quarter, it becomes harder to deploy that fund into investments of the same quality. And so as the manager becomes more successful, the quality of the average investment they will make from that rolling fund will start to diminish. And so if you see a fund that is very successful and it is getting a lot of capital inflow, you have to keep in mind that that's going to make it harder and harder for that fund manager to make investments of that same quality. I'll now talk about two other forms of adverse selection, one at the deal level and one at the market level. As I said, you want your rolling fund to be investing in deals that are very hard to get into. In other words, deals where there's very high demand for investors to invest. There might be a lot of individual advisors vying to invest some of that 1 million that's been allocated in addition to the 9 million that comes from a larger fund to make up a total 10 million investment. And if a startup is really hot, that founder is going to have to select very carefully who's allowed to make a contribution to that $1 million allocation. Now, rolling fund managers themselves are often wealthy, especially if they've previously been successful as a founder. Plus, they may additionally manage other funds with large investors. And so when the deals are very tight and it's very hard to convince a founder to let them invest, the rolling fund manager may prefer to invest A, their own funds, or B, funds of their larger investors, because those larger investors are just a larger source of capital for future investing activities. And so what can happen is the rolling funds portion are more likely to be invested in deals that are not so crowded, which are going to on average be lower quality deals. Now, those who run rolling funds are very aware of this, and so many times they will pre-commit and say something like, I will always invest from this fund. But this isn't always easy. You can try to find policies like this, but at the same time, rolling fund managers, they can appreciate flexibility, and it can be a useful tool as they do investing. So it can be hard to avoid this issue of adverse selection, because there will always be a tendency to favor one's own funds over rolling funds, and also to favor funds from larger investments over rolling funds. A second type of adverse selection is something I've seen empirically with my own investments from 2021 and onwards. When markets were high from 2020 to 22, every quarter my full subscription was being invested and there was no rollover that was being moved to the next quarter. At that time, the startup prices were high, so the deals that my funds were eventually being invested into were expensive. Now, I didn't mind too much because I thought when markets would fall, I would equally be invested in lower price deals and that things would balance out. The markets did crash from a startup perspective in late 22 to 23, but every quarter now I found most of my investment was being rolled over. So even though startup prices had fallen, most of my investment wasn't being deployed. And the net effect of this is funds can easily be invested when markets are high and prices are high, but when prices are low, there tends to be less activity in the market, and it's hard to get a balancing effect whereby you're investing just as much at low prices. As such, I think there can be adverse selection throughout the market cycle. Rolling funds tend to be more popular, and more people will deploy money into them when markets are high. They will deploy themselves more money, and when markets are low, they will deploy less capital. And so there's a sense in which rolling funds can be a case of buy high, but not buy low. If one wants to avoid this phenomenon, it might help to find rolling funds that have been investing over a long time period and invest consistent amounts over the quarters. Further, you might want a fund that limits the total amount it's willing to invest every quarter so that it doesn't have to expand when the market goes up and then contract when the market goes down. Now, this is hard to do because it's tempting to take in more money when markets are hot. The other thing is that doing this means the fund manager has to reject investments when the market is hot. And so you may not even be able to get into the fund until you wait until the markets are in a low position. But keep in mind, there's going to be adverse selection because those rolling fund managers who do very well have a tendency to graduate towards being asked to run much larger funds, leaving those who run rolling funds to be either cases where their talent has not yet been recognized or is not obvious, potentially as well as some managers who are successful but have to limit access to their funds because of their high performance and thereby the high demand for investing in their rolling funds. On a more technical, but just as important note, it's important to understand the implications of effective fees when you're investing in rolling funds. The idea here is that if you invest for a longer period, you're going to be able to offset more of your losses against your gains, and you want to maximize this. If you subscribe for a 4-quarter period and you have some losses in that period and then separately subscribe for another 4-quarter period, then you make a gain in that 2nd quarter period, you won't be able to apply the losses from the first period into the 2nd period. And so the effective percentage carry you're going to pay in the 2nd period will be much higher than it would have been on average. To explain this, let's think about 2 scenarios, A and B. In scenario A, let's say you subscribe for 4 years. That's for 16 quarters all at once. Whereas in scenario B, you subscribe 4 times in a row, each for 1 year, which is 4 quarters. In both cases, you'll invest a total of 100,000. Now let's consider also in both cases that all of the startups fail, except for one in the third year, which returns 200,000. So consider in case A, you're going to have one success for 200,000, and that's more than you put in, 100,000, so you'll get your money back, plus you'll get 80% of the profits. So in total, you'll be returned 180,000. Now in scenario B, where you've invested in 4 separate chunks, you're going to get back 0 for each of the first 3 periods that you invested, because they are each considered separately and they each had losses, so there is nothing returned to the investors. Now you will get your 25,000 back for the 4th period because the 4th period returned 200k. You'll also get 80% of that profit, so 80% of the 175,000 profit. That means in total you'll be returned 25k of your original money for the 4th period plus 140,000 in profit, giving you 165,000 in return, which is of course significantly less than 180,000 you would have been returned if all of that had been treated as one fund. Effectively, because you've subscribed across 4 periods, that has chunked up your investments and resulted in you paying an effective carry of 35%, not the nameplate 20%. The lesson to learn here is that investing in many separate funds, or SPVs as well by the way, greatly increases the effective fees. And this is particularly true if returns are lumpy. All of the losses you have, you're not going to be able to credit those losses for the purposes of fees against the gains that you have in other SPVs. One way you can mitigate this in rolling funds is to subscribe for longer periods, which allows you to diversify further and to have more of your losses applied against your gains, specifically for the purpose of calculating fees. To bring everything together on rolling funds, they do allow some of the benefits of VC funds for smaller investors. Startup quality can be high if the manager has got excellent deal access. However, the fees are high and the effective fees are even higher if you don't diversify or if you have short subscription periods. Last off, there's significant adverse selection that you can face at the deal level because rolling funds are probably not right at the top of the funds that startups would prefer to take in. And second of all, you face adverse selection through market cycles, whereby your funds are likely to be invested when the market is high and less likely to be invested as the market is low. And that's it for this explainer on rolling funds. I hope to do more of these explainers on a quarterly basis. If you'd like to be notified, you can do so by signing up at arrig.com. I myself do not run a rolling fund, nor do I manage funds for others, but I do document my own private and public investments for paid subscribers, and you can check that out too at arrig.com. In the meantime, let me know any questions you have below in the comments. Cheers.